Thank you. On behalf of Antique Stock Broking, I would like to welcome all the participants in the earnings call of Raymond Limited. I have with me Mr. J. Mukund, who is the Head of Investor Relations of Raymond Limited. Without taking further time, I would like to hand over the call to Mr. Mukund. Over to you, Mukund.
Thank you, Priyanka. Good evening, everyone, and thank you for joining us for our Q2 FY2024 earnings call of Raymond. I hope you would have received a copy of our results presentation. I would like to urge you to go through this along with the disclaimer slides. Today we have with us from senior management of Raymond, Mr. S.L. Pokharna, who is Director of Raymond Limited, Mr. Amit Agarwal, Group CFO, Mr. Sunil Kataria, CEO of Lifestyle Business, Mr. Harmohan Sahani, CEO of Realty Business, and Mr. Jatin Khanna, Head Corporate Development. Now I would like to hand over the call to our Group CFO, Amit, who will give you the summary of the company's quarterly performance before we open up for Q&A. Over to you, Amit.
Thank you, Mukund. Good evening, everyone. Thank you for joining us today for the earnings call to discuss the results of the second quarter of fiscal 24. Let me start with a brief overview of the market for the quarter. The quarter witnessed subdued demand, consumer demand, and seasonality. The discretionary spending was impacted primarily due to inflationary pressures and continued higher commodity prices. Additionally, this calendar year also had Adhik Maas, which pushed the festival ceremonies and weddings towards the end of the year. With Pitru Paksh period concluding in the middle of October, all festivals have been delayed, especially weddings have been pushed to November, late November onwards. Now let us delve into the consolidated financial results for the second quarter of fiscal 24. At the inflection point of its transformation journey, Raymond continues to attest its growth momentum with strong quarter-on-quarter performance, and second quarter fiscal 24 was the 9th consecutive quarter that reported highest ever performance both in terms of revenue and EBITDA, despite being in quarter impacted because of subdued demand, consumer demand. Raymond reported revenue of 2,321 crores in the second quarter of fiscal 24 with a growth of 27% on quarter-on-quarter basis as compared to 1,826 crores in the first quarter fiscal 24, and by 6% on year-on-year basis over 2,191 crores in the second quarter of fiscal 2023. This year-on-year growth was driven by our branded apparel and garmenting segment and well supported by the branded textiles segment. At the EBITDA level, we recorded the highest ever quarterly EBITDA of 382 crores with a healthy EBITDA margin of 16.5% in the second quarter fiscal 2024, with a growth of 52% on quarter-on-quarter basis as compared to 252 crores in the first quarter of fiscal 24, and by 7% on year-on-year basis over 358 crores in the second quarter of fiscal 2023. Also during the quarter, the company recorded a cost of about 4 crores during the quarter and recorded an equivalent liability under the share options outstanding account in other equity. This is according to the Raymond ESOP scheme 2023 granted in the first quarter of the current fiscal. Excluding the ESOP cost of 3.9 crores, the EBITDA would have been higher to the tune of 386 crores with an EBITDA margin of 16.6%. During the quarter, the company also recorded an exceptional item of 23 crores relating to the voluntary retirement scheme in our engineering business. Post this exceptional item, we reported net profit of 160 crores during the quarter compared to 159 crores in the second quarter in the previous year. Excluding this exception item, the net profit would have been 177 crores, which is 11% growth over the second quarter of the previous year. Now let me discuss about the segmental performance for the second quarter of fiscal 2024. The branded textile segment reported a steady top line of 933 crores in the second quarter, a small growth of over 912 crores in the second quarter of last fiscal year. The EBITDA margin continued to be healthy at 22%, which is marginally lower compared to 22.3% in the second quarter last year. Here I would like to point out that despite being a slow quarter with market witnessing lower offtake due to delayed festivals and wedding dates, and Hindu calendar also had Adhik Maas, additional month this year, in the suiting business, we were able to garner some traction in the wool blended category by expanding the product portfolio across multiple sales channels. However, the B2C shirting business witnessed stable top line at the backdrop of new launches in the cotton blends category with growth driven in the multi-brand outlets channel. Now let me talk about the branded apparel segment. The branded apparel segment showed a very healthy sales growth of 18% to 437 crore as compared to 370 crores during the second quarter of the previous year. There are a couple of reasons for this growth. One is our distinct product offerings with a new collection for the season that includes vast range of casual wear and increased premiumization. Second, our focused approach of increasing our footprint and reach of our apparel brands. We have rolled out about 100 stores in the first half of the year across metro, tier 1 to tier 4 towns in pan-India basis. Additionally, we have also increased number of doors in the multi-branded outlets and large format stores. The growth was witnessed across all brands with Park Avenue, Colorpress, Raymond Ready to Wear leading the front and well supported by Spark and Ethnics by Raymond. The segment witnessed healthy EBITDA margin of 12.2% in second quarter of fiscal 24 as compared to 9.7% in the previous year. The improvement is mainly due to premiumization and operational efficiencies. Now let us talk about the retail network. We continue to strengthen our retail footprint by opening 63 new stores during the quarter. With the focus to expand our chain of EBOs, 40 branded outlets were added to our existing portfolios across all brands. Ethnics by Raymond being the majority with 17 new stores for the quarter, taking it to a total of 92 stores for the brand as on 30th September 2023. Also during the quarter, we have closed 17 stores, which is mainly a combination of relocation of stores and the closure of some Park brand EBOs as we are focusing on expanding the brand outreach through MBOs, LFS and online channel in line with our stated strategy. As on 30th September 2023, our retail store network stood at 1,453 stores spread across 600 towns and cities in India. Now let us talk about the garmenting segment, which we explained earlier that we are expanding our garmenting capacity by about 1/3 in order to take the advantage of China Plus One adopted by the global brands. Also, this capacity augmentation is in line with Government of India's Make in India initiative. We continue to acquire new customers and we are getting increased size of order from our existing customers. Accordingly, our sales have consistently grown over the last 2 years and in line with the trend, during the quarter we reported 312 crores, which is a robust growth of 18% as compared to 266 crores in the previous year. As we supply to marquee global brands, product quality remains at the forefront as far as customer service is concerned. Therefore, we train our staff well to deliver the same, and as we undertake the capacity augmentation, upskilling of our employees is an ongoing process leading to a build-up of costs. This resulted in the EBITDA margin for the quarter to be at 7.3%, a tad lower as compared to 8.7% in the previous year. In high-value cotton shirting segment, the top line was stable at 211 crores as compared to the sales in the previous year. In the current environment of subdued consumer sentiment, the demand was stable for our cotton and linen fabric offerings by our B2B customers in the domestic market. EBITDA margins for the quarter at 13.2% also maintained as well as compared to the same in the previous year. Now coming to the performance of the engineering business, which is consolidated under JK Files and Engineering Limited on an aggregate basis. The sales stood at 201 crores in second quarter as compared to 228 crores in the second quarter of last fiscal. The sales in the engineering consumers category continue to be impacted by the existing sluggish export markets. However, we continue to cater to the growing automotive segment both in India and export market. In line with our stated strategy of business expansion, market consolidation, and overall margin improvement, we have acquired the business of Maini Precision, which has a strong presence in the automotive segment and as well as into the sunrise sectors of aerospace, defense, and electric vehicle components. We will discuss about the same later in my remarks. Despite the challenges in the engineering consumable sector, we were able to maintain the EBITDA margins at 12.7% for the quarter as compared to 12.8% in the previous year. Now let me talk about the real estate segment. In the second quarter, we launched new projects in Thane of over 1 million square feet with over 2,000 crore revenue potential. We received an overwhelming response from the customers and sold over 40% of the launch inventory in these projects during the quarter. Overall, the real estate business showed a stellar performance during the quarter and recorded a total booking value of over 650 crores in the second quarter of fiscal 24 across all our projects, which is double the booking value as compared to the second quarter of last fiscal. Also, I would like to highlight that we have sold more than 85% of the total units in the first two projects in Thane, namely 10X Habitat and the Address by GS. We have around 100 acres of land in Thane, of which about 40 acres is under development with an estimated revenue of 9,000 crores. The balance land of about 60 acres has a potential revenue of 16,000 crores, which can be developed over the next few years. Considering that the land in Thane is finite, we have taken a leap forward by expanding our presence beyond Thane in the MMR region and would now be developing 3 residential projects based on the joint development route. Now, the first project, which we all know, is in Bandra with a potential revenue in excess of 2,000 crores. Last week, we announced the second project under the JDA route, where Raymond Realty has been appointed as a developer for redevelopment of a prominent housing society located in Mahim West, spread across 3.6 acres. The project is estimated to have a revenue potential of more than 1,700 crores over the project period. Today, we have also announced that Raymond Realty has been selected as a preferred developer for redevelopment of a prominent society located in Sion East, Mumbai, spread over 4.3 acres, and we estimate a revenue potential from this about 1,400 crores during the project period. Put together, the revenue potential from these joint development projects in MMR outside of our Thane land is in excess of 5,000 crores. Now let me give an update on the construction status of all the projects. The construction momentum in all the 5 projects is going quite well, and especially in the 10X Habitat project, first 3 towers have been delivered, which is 2 years ahead of the RERA timeline in December 2022. In Tower 4, lift installation is under progress. Tower 5 to 8, internal finishing is under progress, and in Tower 8 and 9, 37th and 35th flats have been completed respectively. In the Address by GS project, 18th and 10th flats have been completed respectively in Tower A and Tower B. In the 10X Era project, the foundation has been completed for Tower B and plinth slab has been completed for Tower C. In the Address by GS Season 2 and Invictus by GS project, excavation is under progress. The business delivered a sales revenue of 243 crores, which was marginally lower by 2% as compared to 247 crores in second quarter fiscal 23. The revenue recognized during the quarter is not compatible with the previous quarter as we followed the percentage of completion method for revenue recognition, which is based on the incremental percentage of completion of different towers in different projects. The EBITDA margin of 19.5% for the quarter as compared to 25.6% in the same quarter last year. The margins are lower due to initial launch costs for the new project, the Address by GS Season 2, as well as the Invictus by GS. Now let me talk about the working capital and the cash flows. As explained earlier, the festivities and winter weddings have been pushed towards the fag end of the calendar year due to Adhik Maas. Given the fact that majority of the festivities and the weddings are in the second half of the financial year, inventory is made available across all channels in the second quarter in order to cater to the increasing demand in the second half of this fiscal year. Accordingly, the net working capital stood at 1,927 crores as on 30th September 2023, higher by 344 crores as compared to 1,583 crores as on 30th June 2023, and higher by 435 crores as compared to 1,492 crores as on 30th September 2022. In addition to the above, seasonality and with the expansion of Ethnic by Raymond and other branded exclusive brand outlets, the inventory was higher during the quarter. As you are aware, we do primary sales to our sales channel partners, including wholesalers and franchisees of our stores, to cater to the festive season requirement post Pitru Paksh in early October, resulted in increase in receivables. Also, with two new real estate projects being launched during the quarter, there has been an increase in inventory due to construction costs as well as approval costs. Now, regarding cash flows, due to the increase in the net working capital for the quarter, our operating cash flows have been utilized to the tune of 53 crores. During the quarter, we also incurred a capex of 36 crores, mainly in the ongoing capacity expansion in the garmenting and engineering business and maintenance capex across our various plants in various businesses. With the increase in the net working capital and post-capex and interest cost-related outflows, our free cash flow for the quarter was a net utilization of 171 crores. Now let me talk about the consolidated debt position. Our total gross debt stood at 2,851 crores, which comprises of external gross debt of 1,151 crores and NCD issued by Raymond Limited to Raymond Consumer Care Limited of 1,700 crores. We continue to maintain liquidity with cash and cash equivalent of 1,712 crores as on 30th September 2023. I wanted to highlight that the issuance of 1,700 crore NCD by Raymond Limited to RCCL is a temporary arrangement which will be netted off at the completion of the demerger. The demerger will result in two independent, net debt-free, pure-play listed entities for B2C focused lifestyle business and real estate business with engineering business with significant liquidity surplus at the group level to spur the future growth. The interest cost in the quarter is 89 crores, which is higher by 26 crores on year-on-year basis as compared to 63 crores in the same quarter last year. The interest cost has increased on account of the following: that there is an interest cost of 38 crores on the NCDs issued to RCCL, which will be netted off at the completion of the demerger, as the effective date of demerger is 1st April 2023. Higher interest on lease liabilities on account of increase in the stores which are open has been taken on the rental basis. Now let me discuss the current status of the operations and outlook. As stated few times earlier, the onset of festivities and weddings are delayed this calendar year, leading to limited secondary sales. However, from the third week of October, we witnessed a progressive uptick in the consumer demand driven by festive celebrations and the start of the wedding season. We expect the momentum to maintain with the winter wedding season, which has started from November till February-March. In line with our stated guidance, we are on track to expand our retail footprint and will be adding almost 200 stores in the next 12 to 18 months and will follow the asset-light franchise model. This will be driven by large store network expansion for Ethnic by Raymond to cater to fast-growing ethnic wear markets. In the garmenting segment, export lever continues to be China Plus One strategy, and we are focusing on building new strategic customer relationships and gearing up for the increasing demand with the capacity expansion which is well under progress. In terms of our raw material prices, while the wool, cotton and polyviscose continue to remain stable, however, prices of linen flaxseed have also been on an increasing trend. In the real estate sector, the strong customer response to our recently launched premium residential project, the Address by GS Season 2 and Invictus by GS, has been overwhelming in the current quarter as well, and we are witnessing strong booking momentum in our Thane project. In our Bandra redevelopment project, the initial work demolition of the existing building have been initiated and we'll be launching the project in due course of time. In the engineering business, as we announced last week, we have forayed into the sunrise sectors of aerospace, defense, EV components through acquisition of business of Maini Precision Products Limited. This acquisition of Many Precision aligns seamlessly with our business strategy of business expansion, market consolidation, and overall margin improvement. As far as the business expansion is concerned, with a strong foothold in aerospace components manufacturing since 2004, MPPL has integrated 3 sub-verticals: aerospace engines, aircraft systems, aerostructures. The extensive experience positions MPPL to supply the aerospace industry, leveraging long-standing relationships with international customers. And furthermore, MPPL has forayed into defense programs spanning across land, airborne, and naval platforms to collaborate with major defense players in the US, Europe, and Israel. With the acquisition, we will be complementing customers to scale up auto component business. Together, we will be catering to global top auto OEMs in multiple geographies. We will leverage our existing relationship to sell MPPL products by enhancing our product portfolio and utilize MPP existing global customer base to sell our existing products of JK Files and Engineering Group. Margin improvement. The consolidation would help in deriving synergies and operational efficiencies. We will be building operational efficiencies across manufacturing, supply chain process, sourcing, product development, and other operating cost synergies to supplement revenue and earnings growth for both the businesses. Along with the above strategy, we have an experienced and focused strong management team in place. MPPL founder, Mr. Gautam Maini, with his entrepreneurial mindset, will be leading the consolidated engineering business, driving growth and create larger value for the overall engineering business. With this acquisition, Raymond's engineering business will emerge as a large-scale provider of engineering, automotive, EV, aerospace, and defense components, distinctly positioned to target high-growth precision engineering segment with a significant presence across domestic as well as international markets. Raymond Group has always believed in Make in India initiative, and this acquisition will also provide an impetus to the China Plus One strategy that has been benefiting us. Let me provide an update on the demerger of the lifestyle business. Currently, it is in the approval stage with the regulatory authorities with SEBI, and we expect the process to complete in the first quarter of next financial year. To conclude, I would like to reiterate that Raymond Group will continue to have 3 distinct vectors of profitable growth that will create shareholder value for each of the business. To achieve this, we have taken affirmative steps in the form of selling the FMCG business, demerging the lifestyle business, and shaping the scalable real estate business and consolidation of engineering business. With strong free cash flow and no major capex requirement, Raymond Group will remain net cash positive post the transaction. Now, we would like to open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to all participants: to ask a question, you may press star and 1. The first question is from the line of Priyanka Trivedi from Antique Stock Broking. Please go ahead.
Yeah, thank you for the opportunity. So my first question is on our branded textiles business. So the growth of 2% that we have seen, what has been the volume-led growth and what has been the realization growth in this segment?
Yeah, hi. This is Sunil here. So I think we have seen a good healthy mix in our suiting business of polywool fabric, which have done pretty well. So in the suiting business, we have seen a healthy positive volume growth led, in fact, by the polywool fabric. And in case of the shirting B2C business, we have seen a flattish volume growth in line with the market. So overall, I think if you see our EBITDA margins are pretty healthy. And one of the reason is that our mix has improved a lot with a large volume growth being driven by polywool fabric.
Okay. And, if you have to look at our first half performance in the textiles business, we have grown at almost 4% level. So what is the yearly guidance for the textiles business in terms of the growth?
Look, first of all, we are not going to give a specific guidance, but as we have demonstrated, the sum of the growth sectors, which you see very consistently delivered in the quarter, is clearly the branded apparel segment, which witnessed 18% growth. Second is the garmenting. Again, we are putting 200 crore of capex in this segment in order to expand the capacity by almost 1/3. So I think these two segments, we are very, very bullish that these two segments will give a significant growth. And overall, as we have always talked about, that it is not just a question of one quarter or the other quarter. Over a 5-year period, what we are seeing is in terms of revenue growth to the tune of early teens, and in terms of the profitability, we are seeing mid-teens growth across the 5-year period in the lifestyle business.
Okay. And so my third question, you highlighted that the linen prices have been increasing. So what would be the impact in terms of the margins in our B2B shirting business? Any guidance on that front?
Actually, we have been very fortunate in terms of, because of our brand presence and the quality of fabric which we make is like very high nature. Therefore, we have been consistently being able to pass on the cost increases, especially on the raw material side. The last 2.5 years, we have witnessed the cotton price increase from a 32,000 rupees candy. It went to almost 85,000-90,000 rupees a candy. But we have been able to contain and deliver consistently the margins because of the reason that we could pass on the raw material increases to the customer.
Okay. And sir, lastly, my question is on profitability in our JDA business versus our own land projects in the real estate business. And post that, I'll come back in queue.
Raymond?
Yeah. So the profitability, this is Raymond. The profitability on our own land has been quite stable. If you look at our gross margins and the EBITDA margins that we have, it has ranged between 23-25%, depending on which quarter we are in and how, because we follow percentage completion. So it goes 1 or 2% here and there in terms of consistency. As far as JDA model is concerned, JDA model also will give similar profitability in the range. It will be in early 20s. From deal to deal, it can be different, but it will be a similar range.
Okay, sir. Got it. Thank you. I'll come back in the queue.
Thank you. A reminder to all participants, to ask a question, you may press star and 1. The next question is from the line of Varun Pratap Singh from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity. So my first question is on branded apparel segment, wherein we have seen a very strong growth number. I mean, if we compare it with other companies, so the number appears very, very healthy and strong. I just wanted to understand that what would be the same store sales growth, SSG number into this segment, if you wish to call out that.
Yeah, okay. Hi, Varun. I think the same store growth would be in mid-single digits. It's in that range. I think, which again, if you see the trend which we have seen of the industry in the second quarter, has been mostly negative to flat. So I think we have outperformed the industry also in the same store like-to-like growth also. And the two factors which have really contributed to a strong apparel growth is, one is we have kept the focus in terms of our casualization journey. That has happened across most of our brands. So I think that has started, helped us in some of these growths. Second, obviously, our distribution outreach, where we are actually taking a very aggressive go-to-market approach in EBOs as well as expanding our large format store and MBO footprint.
Understood, sir. Very clear. And sir, my second question is on ethnics. Now that we are close to 92 odd stores, which is quite a healthy number, sir. If you want to highlight the health of the business with regards to SSG, revenue performance, So, I mean, anything in this segment, sir, ethnic?
So I think, Varun, as you've seen, that we have ramped up these stores between January to, really October till now. And this is the period when really the wedding season has been very, very lean. And what we are seeing is that it's a good thing that we have now got a reasonable threshold level of stores. The season has just begun around 20 days back. And I think this 20 days are telling us some very, very healthy signs. That the way our sales per square feet is ramping up, it's a very progressive phase, but I can tell you we'll be in a much better shape maybe around 6 months down the line to really give some indication on the health of the business. But what we are seeing, three things which are really giving us good thing is that our product assortment is getting very, very strong reviews across consumers. So we think we have been able to map up a very, very clear positioning in terms of high quality products at a very good pricing. Secondly, our store feel, look, experience, that I think has also worked very well with consumers. Now the third thing which is really happening is we are seeing the business scaling up as soon as the season has come up. You know that this business is very heavily linked to festive and wedding business. I think this is the season which is really first season for us in that sense.
Understood, sir. And sir, one last question if I may. In the lifestyle business, like if we break down our performance in terms of geography, how would we compare revenue growth in tier 1 and 2 compared to tier 3 and 4 cities?
Which segment are you talking of within lifestyle?
Sir, branded apparels.
Yeah. So if you see our presence in tier 4 and 5 and 6 is primarily through TRS, the Raymond stores, and we are focusing through our EBO route and primarily tier 1 and 2. So that's a very clear demarcation of our strategy because we have a very large footprint already of 1,000 plus Raymond stores which span across some 650 plus cities in the country anyway. So if I see that differentiation, I think we are clearly seeing that tier 1 and 2 have performed well, which is in line with a little bit of a K-curve which we have seen across the country. And I think that's panning out across tier 1 and 2 have done well. It's not that tier 4 or 5 are bad, but I think there's clearly a difference between the two segments that we look at. And now what we expect is, a lot of our Raymond stores also are dependent on heavily skewed towards wedding season because that's the time the gifting takes a very large play. And we know that Raymond is part of almost, you can't have a wedding compete without Raymond. It's almost like a jewelry kind of thing. So I think we expect this curve to flatten out a little bit more for us and we'll see growth happening more uniformly across clusters and that's what the hope is here.
Got it, sir. Understood. Thank you very much and wish you all the best.
Thank you.
Thank you. The next question is on the line of Ali Asgar from Motilal Oswal. Please go ahead.
Yeah, thanks for the opportunity. So first question is on brand apparel. So you did mention few points on ethnic wear, but would you be able to just tell me the kind of growth we have seen in brand apparel? How much of that would be contributed from ethnic wear? And if I adjust that, what would be the growth in rest of the brands?
Ali, the branded apparel, what we reported the number for the second quarter is the revenue. And revenue in the second quarter from ethnics cannot be meaningful because, we had no weddings, no festivity. Diwali, Dashara is not there. So what happens, everything what we have done is we have put the store, created the store and made available for the customer. What I can tell you is that the Puja and the Diwali sales which has been seen and which is not the expensive sherwanis and such things, in the kurta and all, we have seen that our product is liked by everyone so much. And the sales what has been seen in the last 10 days is good compared better than what we had even expected. So I think the true testimony of our wedding collection will be seen from now till end of December and then furthermore from February till May and all. So as Sunil pointed out that truly how our ethnics has performed, not performed, we'll come to know in 6 months from now. Then we know exactly, because so far everybody likes our collection. But next important is that the customer has to walk in, buy our product. Because the suit in any case he is going to buy from us. Because that is a natural destination for him for any wedding. So this is an extension we feel, and there is a significant belief with our franchisees and our trade partners that this would also do well.
And we have also, in line with the fact that now we have a pretty healthy threshold level of stores, given this wedding season, we also upped our investments behind ethnics. We clearly believe that it's a strong strategic opportunity for us, and we'll continue to build awareness for this brand.
Correct. So I understand, and in fact, that was my point, that if our H1 has done somewhere about close to 17% growth, certainly 3Q, 4Q, one, because of the festive shift, and second, because ethnic wear you have, in the last 1 year, added more, very significant.
In quarter two, ethnic is pretty much not meaningful,
Correct, and that you in the last 1 year, you have added a very sizable number of stores. So both contribution should drive H2, right? So H2 should be meaningfully higher than what we have seen in H1 in terms of the growth for branded apparel. Right?
Yeah, that's absolutely the plan.
Got it. Okay, second, on the margin front for branded apparel, now I just want to understand the trajectory from 2 points of view. One is that, I understand raw material prices have softened. So how have we, managed it? Have we passed it on? Are we retaining some, given that we had taken very sharp price increases, when the raw material prices were going up? And secondly, given the fact that you will be now in a heavy festive season, and as you mentioned that marketing costs will be aggressive, so, how will you manage both, and what is the kind of margin trajectory we should see for the apparel business, in probably next couple of quarters and beyond?
Yeah. So actually, I think we have discussed that our apparel margin is question of achieving a certain scale because the operating leverage kicks in. And as you continue to open stores, which we talked to you in the next 3 years, 3 to 5 years, we are opening almost 500 stores. So every time you open a store, there is a small investment, maybe not so much direct investment, but advertisement is there to bring the product and the customer to come in. It takes a while. Second thing, as we want to expand the apparel category, ethnics category in a very dramatic manner, these categories require a significant amount of advertisement. And as you would watch over the next few days, starting that we will come back with a very strong ad campaign, and we are going to invest behind the ad campaigns across the 4 apparel brands plus ethnics by Raymond in the next 3 years in order to create a sizable, because this is an investment. In the plant and machinery, you do capex. In the branded business, I think that the investment is by creating the brand and putting the advertisements and market outreach. I think that is why you would see that our margins would stay around the similar level. I think anything between 10 to 12% we would be seeing for the coming quarters to see. And then over the next 4 years, I think we have always spoken that over the 4 years we should get to 14-15% of apparel margin.
Got it. And what about the raw material price softening? How are we playing that? Has we fully passed it on, and has that played out in the existing, inventory?
So after we look, the price softening, as I said, it is such a thing that we have been able to negotiate. We start making combinations, we making blends, and so on and so forth. So effectively, in our business, we have not seen much of an impact because of big time price increase. Maybe 100 basis points here or 50 basis points here and there. It can happen from one quarter to another quarter, but over the 1-2 quarters, it gets stabilized. So I am not so much seeing that the price increases, because we also don't want to give a shock that if I was selling a trouser for 3,000 rupees, I make it to 3,500, and the next season I bring it down to 3,000 rupees, because that hurts the customer sentiment. So therefore, we are trying to maintain more or less the price parity, but we are also, through operating efficiencies and other things, we are able to also maintain the margins in the business.
Yeah. Okay, got it. And last on the textile business, so, we have very clearly, highlighted our strategy of both suiting business where we are expanding in, the premium jackets and the shirting piece where, we are, kind of filling the gap in certain price point that we have not been available. And because of those two factors, our growth should be in high single digit, which is something that we did in 1Q, but 2Q was an aberration maybe for the reason that you already indicated. So should we expect this strategy to enable us to do that high single-digit growth probably maybe, in the third quarter onwards. And you did mention late October has already started showing traction. So is that playing out well?
Yeah. So I think, two things would happen in this. I think from a mid-term to long-term perspective, the strategy stays true for us. Very clearly, we see that we'll do a lot of premiumization in the suiting segment. We're already seeing polywool as a fabric. We're investing with new, products as well, ensuring, as you already rightly mentioned, and it's good to see that you recall that we are filling up the gaps in terms of mass to mass premium price points. And parallelly, we are also expanding our outreach, which we think that is a huge scope to grow that in the shirting business. Now, what will happen is in going forward in quarter 3, quarter 4, I think as the season picks up, then I would say this mid-single-digit strategy should pan out between the two. There could be a quarter here and there of some base effects which may come in because of primary, secondary mismatches of the 2 quarters. But other thing, if you ask me over a 6-month period, 1-year period, yes, we stayed true to this projection that we have given. Plus, one thing which is also panning out well for us is, as we said, that we have also started introducing in a shirting business some very differentiated products like prints. Now we are finding casualization is a theme which is not playing only ready-made apparels. It is a theme which is playing across ready-to-stitch segment as well. So I think that is another segment you'll see some maybe in coming quarters. Some campaigns will also happen around that, where the product development is already rolling out in the market. Plus, hopefully in the next quarter, we also will tell you something new, some new product developments and new segments that we are creating within our suiting business in line with our premiumization strategy. To cut the story short, we hold true to this mid-single-digit kind of a growth over a period of 6 to 12 quarters. Definitely, we should be able to do that.
Understood. This is very clear. Understood. And just last question is on the demerger process. Where are we on that, and when should we expect that to conclude?
Yeah, Ali, you know that in India, any demerger from the time of announcement is a 12 to 14 month process. We have announced end of April. Based on our processes, we look very comfortable that in the first quarter of next year, which is 12-14 months, we should be able to achieve the demerger. I think the process is completely on. We are expecting very shortly the NOCs from various people and then launching with NCLT. And after the demerger, is a traditional 35 to 45 days to take for listing. So I think first quarter, 30th June 2024, should be possible to complete the demerger and the listing of the two businesses separately.
Understood. Thank you so much for answering all that questions.
Thank you. The next question is from the line of Pritesh Sheth from Motilal Oswal. Please go ahead.
Hi. Thanks for taking my question. Firstly, congrats on the real estate business for ramping up your non-Thane pipeline. Safe to say all these 3 projects that we have acquired, including the older one which was in Bandra, would be launched in next 12 months?
So as far as Bandra is concerned, Bandra launch is imminent, and it's at the last stage of approval. So it should happen either within this year or early next financial year. But as far as our plan is concerned, we are budgeting it for it to happen in this financial year itself. So that's Bandra. As far as the other 2 projects are concerned, they both come to us now. And by the time we finish all the planning and approval process, it is going to be easily 12 to 14 months, and not before that we will be able to hit the market. So typically in a real estate project, as you know, the time to market is about 18 to 24 months. But of course we work slightly differently and we try and cut it short. So for us, it is going to be about 14 months or so.
Sure. So, what I meant was FY25, we should see all these 3 projects coming online and contributing to our pre-sales, residential pre-sales. Yeah.
Definitely.
Okay. And just from your broad estimates, since you are closer to launch Bandra, right, the revenue potential that you have indicated for Bandra, even for the recent two new projects, any upside potential in terms of, pricing that we might have assumed when we have underwritten these projects versus probably where the market is right now? Specifically, Bandra was at least 1.5 year back, and since then prices have increased, a bit. So any sort of revisions that you expect in terms of pricing?
Give us the pleasure of surprising you positively.
Hopefully, yes. Sure. And just lastly, I think on P&L side, we have one line item which is cost towards development of property, which is in this quarter little unusually high. While in the presentation you have mentioned that we are still on the 19.5% EBITDA margin. Still clocked 19.5% EBITDA margin. So is this 284 crores all related to residential segment, or there is some other amount also included in this?
All are residential, and basically what we mentioned in our brief, that basically when you launch a project, there is an advertisement cost, there are certain one-time approval costs which you need to incur, and that is a P&L item, and that is why it is reflected into this. And therefore the margin of normal 24-25% is reflected in this quarter to the tune of 19.5%.
Yeah. So we've launched three projects all around the same time. So their marketing expenses are a period cost, and they don't get amortized over the life cycle of the project like all the other costs. And since they are period costs, they come and hit upfront, and the bulk of the cost goes right up front, because at the time of launching, we have to make the market aware of the product being available. So that's really the impact that you're seeing. It will kind of even out over the next couple of quarters.
Got it. But just I was, got that point, but I was just wondering, we had, net sales, net revenue in real estate business of 243 crores, while this expense item is 284 crores, right? So, and still we are saying 19.5% was this EBITDA margin. So, where is that disconnect?
No. Out of that, 100 crore plus is the inventory cost. So P&L impact is less, 160 only.
Oh, okay. So, there is some, item which is netting off about 164 crores, and that is where, it's getting adjusted. Got it. Yeah, fair enough. Yeah. That's it from my side. All the best for all the upcoming launches. Thank you. And happy Diwali to you and your whole team. Yeah.
You too. Thank you.
Thank you. The next question is from the line of Varun Pratap Singh from ICICI Securities. Please go ahead.
Yeah, thanks. Thanks for taking my follow-up question. So my question is on engineering business. I understand our guidance of high teens revenue growth and 20% plus EBITDA growth for next maybe 3-4 odd years. But just wanted to understand that given we mentioned about cost synergies between the existing business and the new business. So how do we objectively measure with regards to this so-called cost synergy between the two business? Also, given that auto is a common element between the two things, between the two pieces of business. So if you can give some understanding about the cost synergy element and as a consequent the EBITDA margin improvement, etc., into the consolidated numbers.
Sure. So look, fundamentally what we are saying is the synergy between the two business would deliver me 250 to 300 basis points improvement on synergy. Now the way the synergy will work out, for example, both the businesses buy a lot of steel. There is a clear possibility to negotiate on the steel. In terms of manpower, the way we have structured, that is there a way we can create a common teams? So that would also help. Third thing, in terms of exchanging better practices, that there has been a lot of innovation on both the sides. We can exchange the practices, good efficient practices on both the sides, which will help us reduce the cost. So, plus, for example, very clearly, we keep the warehouses, Ringplus keeps the warehouse, even Miney keeps the warehouse in different parts of the world. Maybe we can share together a warehouse so that the space utilization can improve and the rental can be saved. So there is a plethora of activities which we have identified which will enable us to get to the synergy benefits. And on top of it, I think fundamentally the biggest thing which I mentioned in my script was that, you see, we supply to some of the top auto OEMs and Miney supplies to some of the other top OEMs. If we get an access in these auto OEMs together, we can cover practically all the top auto majors, which is the single biggest achievement which one can do. And you know it is very difficult to enter into an auto OEM if you don't have an earlier relationship. And that is, in my opinion, one of the very large synergy benefits which will come into this business.
Understood, sir. And second question is, by when, I understand, we have given a guidance that by FY24 we are expected to close the transaction. But still, by the end of Q4, or by when are we expected to start consolidating the numbers?
In Q4, we will start consolidating, but obviously it is subject to some of the external approvals, as we mentioned, that there is a certain external approvals are required. So post that, we will be able to consolidate. And we expect that to happen during the fourth quarter.
Okay, Amit sir. And sir, last question is again in the apparel segment. So there has been one common observation that the premium price point may be not growing as fast as the value price point. As a consequence, we see several oldies or several companies entering into the value format. For example, Stop entered into the Zudio kind of a market at the price point. Reliance has entered into the same market. Arvind exists in the same market now, maybe ramping up their plans, etc. And also, for example, if we see last 4 or 5 years, there has been examples of few companies not growing. Maybe the store expansion, for example, Zara would not have added much store over the last 3-4 years. So having said that, I understand our portfolio is relatively strong, robust, and we have all price points also which we are catering to. But having said that, given so much of excitement, for example, Trent result also, it has been quite strong, and so much excitement around this so-called value format. Given that we have entered into ethnics, do we also not aspire to maybe enter into this very segment where there has been so much of excitement?
No, okay. No, so I think first of all, I think there are two parts to happening. There are two phenomena very clearly happening in India. India is seeing a very large wave of premiumization, which is very clearly panning out that every segment that you take, whether it's automotive, whether it's real estate, whether you see jewelry, there's a large piece happening that the premiumization is playing out. So people who always had money, who actually, have the money disposable income, they're actually spending more and more on high value items. And that's where we are also seeing a trend very clearly for our product portfolio. Second trend which is happening is, yes, there's a K-curve happening in the mass and there in fact there's a down trading happening. So both premiumization and down trading are playing out. In down trading, you're seeing this trend that the players who are below 500, 600 segment, that also you're seeing some wave happening. Now the question for us, there's a very clear large play already possible. We play in the mass premium to premium end. So I think there's a huge scope for us across our brand on multiple vectors of growth. One is that we are going through expansion of go-to-market, which is standard across brands. Second, we are going through casualization. Third, we are going through premiumization. So I think, and obviously the fourth sector is getting into a new adjacent category like ethnics. So for us, there's enough large market to grow that rather than change our strategy or looking at it to a sub-600 kind of a value for money segment, we don't see that as a critical area for us. We have enough room to grow across between mass premium to premium and through adjacency. And that is something which we're doing. Having said that, our Parks brand, anyway, that's a conscious call which has happened in the Parks strategy, that for Parks we'll not do EBOs. because it's a value brand. It is not a 500 minus brand. It's a brand which is, I would say, mass brand. And that segment we are catering to the park, and we are saying there we would rather not spend money on EBOs, we'd rather go and expand outlets through multi-brand and large format stores where there is an automatic flow of consumers, so that you can participate in a share game there.
And also just to add that, look, as Raymond, we have got 12 million CRM base, and the way the affluence is coming in our country, this will always show that people moving up the value chain. If we are able to cater to even that much of a segment, even 50 million customers, if we are able to cater to, I think the revenue has a full potential to grow in high teens or even crossing 20% plus growth in the apparel segment. This is such a big market.
Understood. And sir, what about beauty segment? For example, we have seen listing of some of the beauty companies also, and as Raymond has been relatively under-indexed in the beauty side. So will we also not aspire to venture into this very segment and kind of exist with the lifestyle or apparel dominated plus the category extension that we are doing? That's my last question, sir.
Yeah, look, at the end of the day, you see, we just sold our FMCG business, which was into the personal care. Now, there is a reason why we sold the business. Though we have absolutely no non-compete available, we can start the FMCG business from today to tomorrow. However, what I want to add is that we believe there is a significant growth potential across our all businesses, be it the branded fabric, through big way in a shirting. Second thing, on the branded apparel, see our revenue, even if you take it a 1600 crore, this is a $50 billion market, growing to $75 billion market over the next 5 years. So there is a huge opportunity, and the whole shift is happening from an unorganized sector to an organized sector. That opens up a lot of space for people like us. So therefore, we feel that there is significant opportunity in our own segment to cater to, and we can do a much better business, which you know, and you have done it for so many years.
Yeah, and also, within the lifestyle current business, within the men's apparel itself, there are so many adjacencies which are possible, which we can nurture. And I would rather focus where we have a right to win, which is so obvious to us, rather than getting into segments where you can say, okay, is our right to win really very clear?
Understood, sir. That's it from my side. Thank you very much.
Thank you. The next question is from the line of Ruben Matthews from Equity Intelligence India Private Limited. Please go ahead.
Hi. Good evening. Yeah, thanks for this. I just had a quick question on the financials. Can you shed a little bit more light on why there was an increase in the receivables, and maybe on which segment? Is it primarily for the branded apparel? If you could just give a little bit of explanation on that, that would be great. Thank you.
Yeah, sure. You see, as we talked about, that the dealers and the franchisees are expecting a very strong second half of the year based on the festivities as well as the wedding season. So normally what happens when they buy the product, they bought the product mid to late September, and that stood as receivables in our books. So this is primarily for the lifestyle business, and it is a classical case because of seasonality. Every year the same thing happens. Now this time it is slightly more delayed because the Pitru Paksh continued till 15th of October. Otherwise, you would have seen by 14th of September, 15th of September, the Pitru Paksh gets over, so people start to take the material in mid of August, whereas this year they started to take mid to late September. And that's the simple reason which we believe can be during the quarter, this quarter and the next quarter, we will be able to bring back the normalcy to the working capital.
Okay, thank you.
Thank you.
Thank you. A reminder to all participants to ask a question. You may press star and 1. As there are no further questions, I would now like to hand the conference over to Mr. Amit Agarwal, Group CFO, for closing remarks.
Thank you very much, and we convey our wishes of Happy Diwali and prosperous New Year to each one of you, and we will talk in the next year. Thank you.
Thank you. On